Okay, real talk. The IRS is not going to call you up and say, hey, just so you know, you overpaid us by $4,000 last year. Our bad. Here's a refund and a fruit basket. No, that is never going to happen. And that's exactly why I'm making this video. Because right now in 2026, there are legal tax moves sitting right there on the table that most middle-class families have absolutely no idea exist. And I'm not talking about some shady offshore account nonsense. I mean real legal deductions and credits that Congress literally passed into law last July with the One Big Beautiful Bill Act. Yeah, that's the actual name. I didn't make it up. And most families earning between $50 and $150,000 are going to file their taxes this year and completely miss thousands of dollars they're legally entitled to. So stick around, because by the end of this video, you're going to know exactly how to keep more of your own money. And the math on some of these is going to genuinely surprise you. Let's start with the easiest one first. Trick number one, the boosted standard deduction. This is the one everybody technically knows about, but nobody actually does the math on. For 2026, the standard deduction for a married couple filing jointly is $32,200. For a single filer, $16,100. And for head of household, which a lot of single parents qualify for, by the way, it's $24,150. Now here's where it gets interesting. If you're 65 or older, you get an additional bump on top of that, an extra $2,050 per person if you're single, or $1,650 per spouse if you're married. But wait, because the One Big Beautiful Bill also created a brand new senior bonus deduction of $6,000 per person. That's on top of everything else. So a married couple, both over 65, could shelter up to $47,500 of income before they owe a single penny in federal tax. That's not a typo. 47.5. If grandma and grandpa are sitting at home thinking they owe the IRS money on their Social Security, somebody needs to send them this video immediately. And here's the thing a lot of people don't realize. If you don't have a huge mortgage or massive charitable donations, the standard deduction almost always beats itemizing now. It's literally designed for middle-class families who don't have a bunch of fancy write-offs. So take the easy win. Trick number two, no tax on tips and overtime. This one is brand new and it is a game changer for working families. Under the One Big Beautiful Bill, if you work in one of about 68 IRS-approved tipped occupations, think servers, bartenders, hairstylists, rideshare drivers, hotel staff, you can now deduct up to $25,000 in tips above the line. That means you don't even need to itemize. It just comes straight off your income. Let's do the math. Say you're a server making $80,000 a year with $20,000 in tips. At a 22% tax bracket, that tip deduction saves you $4,400. That's not a coupon for 20% off at Applebee's. That is 4,400 real dollars back in your pocket. And it gets better. There's also a new deduction for overtime pay, up to $25,000 for a married couple or $12,500 if you're single. And this is specifically for the overtime premium, the extra half of time and a half. So if you're a nurse, a factory worker, a first responder pulling extra shifts, that overtime premium is now tax-free. Quick example, you work $10,000 in overtime premiums at a 12% bracket. That's $1,200 saved. Combined with tips if you're in both categories, a working family could potentially shelter $50,000 in combined tip and overtime income on top of the standard deduction. The income phase-out doesn't even start until $150,000 for single filers or $300,000 for married couples, so the vast majority of middle-class families qualify. Now, here's the detail people miss. Payroll taxes, Social Security, and Medicare still apply to tips and overtime. This deduction is for federal income tax only. Still a massive win, but I want you to have the full picture. Trick number 3, stack those family credits. This is where it gets really fun if you have kids. The child tax credit went up to $2,200 per qualifying child under 17, and up to $1,700 of that is refundable, meaning even if you owe zero in taxes, you can still get up to $1,700 back per kid as a check from the IRS. 2 kids? That's $4,400 in credits. 3 kids? $6,600. And this phases out at $200,000 for single filers and $400,000 for married couples. So almost every middle-class family qualifies for the full amount. But here's the one that really gets overlooked. The Child and Dependent Care Credit got a massive upgrade. The maximum credit rate jumped from 35% all the way up to 50% under the new law. If your adjusted gross income is under around $45,000, the IRS will now cover half your child care costs up to $3,000 per child or $6,000 for 2 or more kids. That means a family with 2 kids in daycare could get up to $3,000 back just for the child care credit alone. And there's more. The Dependent Care FSA, that's the flexible spending account through your employer. The limit jumped from $5,000 to $7,500. That's an extra $2,500 in pre-tax dollars you can set aside for childcare. If your employer offers this and you're not using it, you are literally saying no thank you to free money. Stack the child tax credit plus the care credit plus the FSA, and a family with 2 young kids could easily be looking at $7,000 to $8,000 in combined tax benefits. That's a used car. That's 6 months of groceries. That's real money. Trick number 4, the auto loan interest deduction. This one is completely new and almost nobody is talking about it. If you bought a new car, and I mean new, not used, and it was assembled in the United States, you can now deduct up to $10,000 a year in auto loan interest. The loan has to have been originated after December 31st, 2024, and the vehicle has to weigh under 14,000 pounds. So basically, any normal car, truck, or SUV qualifies. Let's say you're paying 5% interest on a $35,000 car loan. That's roughly $1,700 a year in interest. At a 12% tax bracket, that deduction saves you about $200. At 22%, it's $374. Not life-changing on its own, but combined with everything else we've talked about, it adds up fast. The income phase-out starts at $100,000 for single filers and $200,000 for married couples. And your lender will send you a new form called the 1098 VLI with the exact interest amount. Just make sure your vehicle has a VIN that confirms U.S. assembly. If you leased or bought used, unfortunately, this one doesn't apply. But if you financed a new American-made vehicle in 2025 or 2026, go claim this. It's free money sitting there. Trick number 5, retirement deductions and the saver's credit. This one isn't new, but it's still the most underused wealth-building tool in the entire tax code. For 2026, you can contribute up to $24,500 to a 401k and up to $7,500 to an IRA. If you're over 50, you get an extra $8,000 in catch-up contributions for the 401k. And if you're between 60 and 63, there's a new super catch-up of $11,250. But here's the real trick. Every dollar you put into a traditional 401k or IRA reduces your taxable income dollar for dollar. So if you're a married couple earning $100,000 and you each contribute $500 a month to your 401k, that's $12,000 a year coming straight off your taxable income. At the 12% bracket, That's $1,440 in immediate tax savings, plus whatever your employer matches. Many employers match 50 cents on the dollar up to 6%. On a $50,000 salary, that's an extra $1,500 a year your boss is giving you for free. If you're not getting the full employer match, you are declining a raise. And if your income is under about $40,000 single or $80,000 married, look into the Savers Credit. It gives you an additional credit of 10 to 50% on up to $2,000 in retirement contributions. That's up to $1,000 extra on top of the deduction. It's a credit on top of a deduction. It's like a buy one, get one at the tax store. Now the bonus trick, because I always give you one more. The new above-the-line charitable deduction. Even if you take the standard deduction and don't itemize, you can now deduct up to $1,000 in cash charitable donations or $2,000 if you're married filing jointly. This is brand new under the One Big Beautiful Bill. Before this, if you didn't itemize, your charitable giving got you exactly nothing on your taxes. Now it does. So if you're already donating to your church, a local food bank, whatever cause matters to you, make sure you're tracking those receipts because Uncle Sam is finally giving you a little something back for it. Let's zoom out for a second and look at the big picture. If you're a married couple, both working, one of you earns tips, you've got 2 kids, and you bought a new car last year, here's what your 2026 tax situation could look like. $32,200 standard deduction, up to $25,000 in tip deductions, up to $25,000 in overtime deductions, up to $10,000 in auto loan interest, $4,400 in child tax credits, up to $3,000 in child care credits, plus the Savers Credit if you're contributing to retirement. We're talking about potentially sheltering over $90,000 of household income from federal taxes and getting thousands back in credits on top of that. That is not a rounding error. That is a completely different financial reality. And look, these aren't loopholes. These aren't tricks that only rich people's accountants know about. These are tools that Congress specifically designed for working families. The problem is, nobody tells you about them. Your employer doesn't tell you. Your bank doesn't tell you. And the IRS sure as heck isn't going to volunteer the information. But here's what you need to know. Most of the new deductions from the One Big Beautiful Bill, the tips, the overtime, the senior bonus, the auto loan interest, they all expire after 2028. The SALT cap increase expires after 2029. So you've got a limited window to take advantage of these. Don't let it pass. Now I want to hear from you. Drop a comment and tell me which one of these you didn't know about. I bet at least one of them caught you off guard. And if this video helped you, do me a favor. Hit that subscribe button. We put out videos every week breaking down the money moves that nobody else is telling you about. Share this with your family, your coworkers, anybody who files taxes. Because honestly, that's everybody. The more people who know this stuff, the more money stays in our communities instead of getting left on the table. I'll see you in the next one.